FAR.F3.M5.
So, Jenna, I think depreciation gets an unfair reputation. People hear the word and immediately think, great, here comes another formula. But I don't think depreciation is really about formulas at all.
I agree. The formulas are actually the easy part. The difficult part is understanding what question depreciation is trying to answer. Every depreciation method is simply trying to spread the cost of a long-lived asset over the periods that benefit from using it. That's the matching principle in action.
That's the big picture I want everyone to keep in mind. Imagine buying a delivery truck for a business. You don't buy that truck so it can make money today. You buy it because it's going to help generate revenue for years. So it wouldn't make much sense to expense the entire purchase on day one.
Exactly. Instead, accounting gradually recognizes that cost over the truck's useful life. That's depreciation. You're allocating cost, not measuring market value.
That's probably misconception number one. People hear depreciation and think the accountant is estimating what the asset is worth today.
And that's usually wrong. Depreciation doesn't tell you what something could sell for. It's simply allocating historical cost over time. An asset can actually increase in market value while still being depreciated.
Let's start with the kinds of depreciation the textbook introduces. There's physical depreciation and functional depreciation. Physical seems obvious.
Right. Physical depreciation comes from wear and tear. Machines wear out. Buildings age. Vehicles accumulate mileage. Functional depreciation is different. The asset might still physically work, but it no longer performs efficiently enough.
Like carrying around a flip phone today. Nothing's actually broken. It's just
obsolete. That's exactly the word the textbook uses. Technology changed. Customer expectations changed. The phone still functions, but it's no longer economically useful the way it once was.
That's a nice distinction because the FAR exam loves asking why an asset lost usefulness, instead of simply asking whether it did.
Now, before we calculate anything, there are two estimates that drive nearly every depreciation method: estimated useful life and salvage value.
Salvage value is basically what you expect to recover when you're done using the asset.
Yes. If the asset is expected to have value at the end, you don't depreciate that portion. Only the depreciable cost gets allocated.
Here's one of the Becker pass keys that candidates constantly overlook. The exam frequently places an asset into service sometime during the year.
Exactly. Always pay attention to the placed in service date. Depreciation starts when the asset is placed into service, not necessarily when it was purchased or paid for. If it enters service halfway through the year, you're generally looking at partial year depreciation.
That feels like an easy point to miss because you're already focused on the depreciation method itself. Meanwhile, the exam quietly slips in one date.
And that one date changes the answer. Russell, let's move into the different depreciation methods.
Straight line first. I like thinking of this as slicing a loaf of bread into equal slices. Every year gets exactly the same size slice.
That's actually a helpful analogy. The cost is spread evenly because management expects the asset to provide roughly equal benefit each year. The formula itself is straightforward. Depreciable cost divided by useful life.
Simple, predictable, no surprises.
Which is exactly why it's probably the most commonly encountered method. Now compare that with some of the years, digits.
This one sounds scarier than it really is.
Much scarier. Conceptually, it just accelerates depreciation. More expense early, less expense later.
It's kind of like eating the biggest slices of cake first. Eventually, there's less left.
That analogy works pretty well. The asset is assumed to provide more economic usefulness, or at least incur more cost allocation in its earlier years. So larger depreciation comes first. Smaller amounts follow later.
Then we have declining balance. And honestly, I think students sometimes lump it together with some of the year's digits because both are accelerated.
Which is understandable. The mental model is what's important. Both accelerate depreciation. They simply arrive there differently. For FAR purposes, recognize the pattern rather than memorizing every possible computational variation.
Finally, we have units of production. This one feels completely different.
Because instead of measuring time, it measures activity. Think about mining equipment, or manufacturing machinery, or equipment whose wear depends on output rather than calendar years. The more units produced, the more depreciation recognized.
Almost like paying by the mile instead of paying by the month.
Exactly. Time doesn't drive depreciation. Usage does.
Now, let's talk about something candidates sometimes confuse. Component depreciation, composite depreciation. These sound similar? They're definitely not.
Let's imagine an airplane. It has engines, landing gear, avionics, fuselage. Those pieces don't all wear out together. Component depreciation says treat major components separately. Each gets its own useful life, its own depreciation. And if one significant component gets replaced, the old component is removed from the books.
So instead of treating the airplane like one giant object, we're treating it like several important assets working together.
Exactly. Now compare that to composite depreciation. Composite depreciation groups multiple assets together. Instead of tracking each individually, you're depreciating the group as one combined collection.
That's almost the opposite mental model. Component says separate everything. Composite says combine everything.
Perfect. If you can remember that contrast, you'll recognize most exam questions immediately.
Eventually, every asset reaches the end of its story. Either we sell it, throw it away, replace it, or something happens that permanently reduces its value. Those last two situations are where students start mixing concepts together.
Let's separate disposal from impairment. Disposal means you're getting rid of the asset. Impairment means you're keeping it, but it's no longer worth what the books currently say. Those are entirely different accounting events.
Here's an analogy. Imagine owning a car. Selling the car is disposal. Discovering the engine has catastrophically failed, but you're still keeping the car is impairment.
That's actually a strong analogy. The ownership changes in one situation. It doesn't in the other.
Let's walk through disposal first.
Whenever an asset is disposed of, you're comparing its carrying amount with what you receive. That comparison determines whether there's a gain or loss. The textbook expects candidates to recognize journal entries for sales, write-offs of fully depreciated assets, and permanent impairment situations.
Here's something easy to overlook. Once the asset is disposed of, you stop depreciating it. Because it's gone, there's nothing left to allocate.
Exactly. Now let's shift to impairment. This is one of the highest value conceptual areas in this module.
And honestly, this is where students often panic because there's a two-step process.
Fortunately, the logic is much easier than it first appears. Step 1 asks one question. Is the asset recoverable? The textbook explains that you compare the sum of undiscounted expected future cash flows with the carrying amount. If future undiscounted cash flows are less than carrying amount, the asset fails the recoverability test. Only then do you move to step 2.
So step 1 isn't measuring the loss. It's simply asking whether there's even a problem.
Exactly. Then step 2 measures the impairment. The impairment loss equals the amount by which carrying value exceeds fair value. That's the actual write-down.
I like picturing it like visiting a doctor. Step 1 is determining whether you're actually sick. Step 2 is deciding how serious it is.
That's a really effective analogy. Don't skip straight to treatment. First, determine whether treatment is necessary. The impairment model works the same way.
Now, here's one of those strange accounting rules that's easy to remember precisely because it feels strange. If fair value later improves, can we simply reverse the impairment?
Generally, no. The textbook specifically points out that if an impaired asset is held for use and fair value later rebounds, restoration is not permitted. Once written down for a held and used asset, that impairment generally stays.
That feels counterintuitive.
It does, which is probably why it's tested.
But then comes the exception. Held for sale assets.
Exactly. If the asset is classified as held for disposal, depreciation stops. And if fair value partially recovers before the sale occurs, restoration may be permitted. Notice how different that treatment is from assets held for use.
So, the exam might present two very similar looking scenarios. One asset continues being used. One asset is held for sale. Everything changes based on that single fact.
That's why reading carefully matters more than memorizing isolated rules.
Let's zoom out and build the entire mental map one more time. You buy an asset because it'll help earn revenue over many years. Depreciation allocates its cost. Different methods simply reflect different patterns of allocating that cost.
If the asset loses value unexpectedly while you're still using it, think impairment. Recoverability first. Measurement second. If the asset leaves the company entirely, think disposal. Compare carrying amount with what you receive. Recognize any gain or loss.
Component depreciation. Break one asset into meaningful pieces. Composite depreciation. Treat many assets like one larger group.
Straight line? Equal allocation. Accelerated methods? More depreciation early. Units of production? Usage drives expense instead of time.
And never forget the passkey. Check when the asset was placed into service. Partial year depreciation shows up surprisingly often.
If listeners leave this episode remembering one thing, I hope it's this. Don't memorize isolated formulas. Instead, identify which stage of the asset's life you're looking at. Acquisition, depreciation, impairment, or disposal. Once you know where you are in that life cycle, the accounting treatment becomes much easier to recognize.
That's really the theme of this whole module. You're not memorizing dozens of disconnected rules. You're following one long-lived asset from the day it arrives until the day it leaves. And once that story makes sense, the FAR questions become much less intimidating.